What's going on, Lucia Capital Group family, friends, clients, and colleagues? I'm your special guest host for the day, Chris Poniotu. And today we have an extremely special guest, the Dr. David Blanchett. Now, before we get into the interview today, an oh so proper introduction is much needed. Now, for starters, David is the head of the Retirement Research Division of Morningstar Investment Management, one of the largest investment research firms in the world. He's published well over 100 different research articles on various financial planning topics. Now, not only is he a certified financial planner, a chartered financial analyst, he thought it'd be great to go back for one more and get his PhD in personal financial planning. To cap all that off, he's an absolutely incredible guy. We've actually become pretty good friends over the last couple of months. And the only thing I will ever hold against him is he is a massive Kentucky basketball fan. So with that, welcome to the show, David.
Be here. Thanks.
Yeah, absolutely. Now, when we met, the first thing I told you was how thankful I was for all of your research. If it was not for you and your research, a lot of us planners, myself included, I don't know where we'd be today. Now, before we dive into the bulk of our interview today, I want you to kind of give our viewers at home a little bit of your background, because you weren't always on the research side. You used to be on our side of the fence. So tell us a little bit about yourself.
Fence, Chris. I'm still there.
Yeah, I know.
Well, no. So, if I go way back, I used to do financial planning for people. I was actually drawn to the industry in high school. I don't know what it was, but I always liked the idea of helping people make better financial decisions. And so, over time, I did planning. I really enjoyed the research side of things. And so I make the joke that I've been climbing an ivory tower for 15 or 20 years. And, today, while I'm not doing planning for individuals, I do kind of help institutions and other folks develop tools that implements financial planning. So I'm still working with you, just in a different way than I was maybe originally.
So would you categorize yourself more as the, the planner of planners, if you will?
Yeah, I'm the guy that helps create the tools that planners use for financial plans. I work, with a robo advisor as well. I help other institutions that have planners develop models. It's just a whole hodgepodge of things.
It sounds like absolutely loads of fun for you, me, and like 5 other people. So thank you for doing what you're doing. Let's get into the bulk of the discussion today. Let's take it back to May 29th of this year. So Think Advisor posted an article that summed up a webinar that you and another great researcher, Michael Fink, summed up withdrawal rates for pre-retirees and retirees. Not to get into the weeds, because I want you to talk about the majority of this, but back in December of 2019, you were actually saying that was the time to take some of these gains off the top of the market and move into something more conservative. Now at Lucia, we're all about buckets. That's our identity. So for us, our term is rebucketizing. Now you fast forward to today, markets are arguably at their high again. So question 1, does that same strategy still apply in your humble opinion? And then also, let's pretend this was March 31st. Would you still rebucketize? Talk to us about that.
There's a lot to unpack there. I actually, when I was a planner, I have experience using buckets. I'll never forget a client, I showed them they should be in a 60-40 portfolio and they freaked out. And when you show it to them in 3 different buckets, oh, it seems fine. So what you're doing is you're kind of repackaging a portfolio to help them understand. I think that the way it works, though, really varies by client. Engineers are different than an office worker. And so I think really the key behind all of it is how do you help someone make better financial decisions? And a lot of that is rebalancing, getting a portfolio back to its target. But that can be hard to do, right? It's hard to tell someone when the markets are down, hey, let's buy more equities effectively. So again, everybody's different, but I think creating strategies that helps them understand is one of the most important things advisors do.
I'm thinking of, it's really easy when the market is up. So that's always a fun conversation. Let's take some of that gain off of the table. Um, where it gets kind of interesting is, let's say that opportunity was missed, but you still need to have some proper diversification. Go back to March 31st. Let's play a worst comes to worst for a second. Would that still apply? Or how would you handle a situation like that?
Well, I mean, to your point, the one thing that advisors should always be doing is setting expectations, right? Unfortunately, markets don't go up forever, right? They have to go down at some point. And so hopefully what you're doing is as markets go up, you are taking gains off the table and you're saying, hey, right now it's easier to de-risk. You're going to actually add on risk to some extent when things go bad. And so if you prepare them for that, hopefully it's not as painful as might be when they're a new client. But to your point, for a new client, it can be different. I mean, everyone's different, right? And so, the key is to keep them in the plan. And I think too often when people do research and everything else, they assume that one, clients are rational, and that two, that clients will keep their advisor. And so, the worst thing that, if you have a good strategy, the worst thing that can happen is for some reason the client doesn't understand it or like it, and then they fire you and do the exact opposite of what you were suggesting, right? So I think from my perspective, there isn't one right answer. It's really what it takes for the client to follow, the right path over time.
Now, based on everything that you just said, which I could not agree with more, what are you seeing uh, planners doing today for those clients as far as the pre retirees and retirees? And if they're not doing what you think, what would you say planners should be adding to add the most value?
Well, I mean, I think that planners is kind of a broad bucket. Planners do a lot of different things. I mean, I had some experience working with a lot of planners back in the 2008 crisis, and uh, I saw some of them make some pretty terrible decisions. I actually had one planner that I knew that moved his clients like all the cash like 3 days before the
Uh,
market bottom, and then never got him back into it. And so I think that there's a benefit to being a little tactical. I think that, but you can't send the wrong signal. I don't like the idea of advisors saying, "Hey, let's move all of it to equities, all to cash, or whatever else it is." I think that the key is to keep clients invested for the long haul and focus more on kind of the other stuff. I think that it's the financial plan, it's the strategy, it's the goal. That's what really matters. And so investments are an important part of that, but it's not the only part. It's the other stuff that I think actually adds value in these relationships.
One question that, and it comes up in multiple ways: have I done enough? Have I saved enough? Or how am I doing versus the average person? I always think that's kind of an interesting thing, because what's average? So, what would you define as financial success?
I mean, it's just accomplishing your goals, whatever they are. I mean, some people don't need money to do that. I mean, there's human capital, there's social capital, there's financial capital. I mean, if you look at retirees, they're actually a really happy bunch, and most of them are pretty broke. I don't know that I want to compare myself against the average investor or saver, because the average saver isn't doing a very good job. I mean, financial wealth won't necessarily make you happy, right? And retirees have done a pretty good job about finding happiness other ways. But a lot of people, it's really important to them that they want to travel, they want to see their grandkids, they want to do things, and it takes sacrifices to get there, right? And so again, it's finding that way that you're comfortable doing that. And as a society, we are terrible savers. We are just the worst savers around. And so I'd like to see that change, but I just don't know that it will, for a whole host of reasons.
So, my question, I guess, is just how to get people to really just remove all that and enjoy it, because it blocks the enjoyment from retirement.
Well, I mean, so like I don't know if this answers your question, but one thing that I think is very real is this fear of spending money. I think that it's really, really hard to have a portfolio that you've got to spend down every month or every quarter, every year for some unknown time period, right? So I think that you need to think about ways to make it easier to spend down. But to your point, everyone's different. I'll never forget when I actually first, one of my jobs earlier on was to do financial plans for advisors. And I was just shocked that everyone's number was different. Like there wasn't a single planet that had the same like target income goal at retirement. That's because everyone is different. And so to me, when someone says, "Well, how am I doing?" It's more of, "Well, what do you want to accomplish?" And so, like, this is the path you're on right now. How do you feel about that path? And if you don't like it, you're going to have to make changes. And that's really kind of about it. Because to your point, like my parents retired at the age of like 52 because they had a generous pension because they were both teachers and they're doing great, but they're happy. I mean, are they wealthy? They're not wealthy by a lot of definitions, but they're happy because they like what they've got. And so, to me, it's everyone's different, but it's about helping them find that place that they can get to that lets them save or spend how they want to.
Uh, One thing that, because we're almost out of time, but you brought something up earlier about the 60-40 stock bond mix. And for those of you that are watching, back in the day, if someone wanted a balanced blended portfolio, it was kind of this popular belief where you would have 60% of your portfolio in stocks, something more aggressive, and then 40% of your portfolio in bonds. But what would you say to mitigate a lot of those risks that a 60% stock, 40% bond market have? Because there is a lot of risks there. We don't know what the next half of this year is going to look like. That is for darn sure. But we know interest rates are super low. And when interest rates rise, it's not looking good for our bond heroes out there. And if there's a correction with the stock market, when the tide goes out, that could be kind of scary. So, what are your thoughts on all that?
Yeah, I mean, I think that the word unprecedented has been used a lot to describe the markets for the first two quarters of 2020 or 2020, whatever.
It's still 2020.
We're good. And I don't know that that's going to change, right? And so I think that it's really important that you have a portfolio that you're going to be comfortable sticking with. I actually really like the 60-40 portfolio. Half-ish to your portfolio in stocks, half-ish in bonds. I think there's a few important things, like you should have high quality bonds like government bonds for most of the fixed income piece. Maybe have a lot of U.S. international equities for the stock piece, but it's going to go up and down. That's part of investing. And a lot of people don't like market volatility, and I say, well, if you don't want market volatility, you can go out and buy treasury bonds, but they're yielding like not even 1% right now. And if
0.15 as of yesterday.
you want a financial plan where you have 1% return on bonds, and then you tack on taxes, fees, inflation, that dramatically changes everything. So it's a choice. I mean, if you don't want market risk, you can save a lot, but I think people have to kind of have that risk. And so the key is not then taking on too much risk. I've talked to people that say, oh, I'm behind, I'm going to invest all in equities, and that can have the opposite impact.
Right. And yeah, I seriously, I could interview you for hours on end, but then it would just be you and me, and then maybe our parents are watching, and that's about it.
Mine aren't watching. I can tell
Yeah. Okay. So just to kind of close this out, again, we have no idea. And I guess you could argue no one knows what's going to happen for the next half of the year, but holy cow. But what are some of the things that you would recommend for people to look out for, both in things that you can control and things that are uncertain and we need to mitigate?
Well, I mean, to your point, we can't control the market. The market had rallied. It's rallied quite a bit since the end of Q1. Let's just say it could go back down again. Who knows, right? The key is people that get hurt investing, they panic, they sell out, and so an important question is always, what can you do to mitigate that feeling of shock? And a lot of folks, I think, it's having a financial advisor, having someone they can rely on to keep them to stay the course, right? So that's the kind of the uncertain thing that you cannot control, market volatility. What can you control? Like, again, like do you have enough insurance? Are you saving enough for retirement? Like, are you making good financial choices with what you've got, acknowledging the uncertainty? And I know a lot of folks have lost their jobs, or bad things have happened, and so for them, I'd say it's rough right now. But start planning ahead. So when you do get another job, when things turn around, don't just all of a sudden go buy a new car. Create a plan so that when you recover financially, or you get back on your feet or whatever, you know what you're going to do, so you don't make kind of impulsive or reckless decisions.
Awesome. Awesome. And David, I wanted to say thank you so much for coming on Lucia Weekly. We greatly, greatly appreciate it. And as far as for the viewers at home, thank you so much for watching, tuning into Lucia Weekly. If you have any questions regarding this interview, please do not hesitate. shoot me an email, chrisp@luciacap.com, or give me a call for whatever reason. If you don't want to talk to me and you want to talk to another advisor at Lucia who's just as entertaining, call 1-800-644-1150. And I'm sure the other advisors would love to take your call. Thank you so much for watching. Stay safe, stay humble, and I'm sending a big old virtual hug to every single one of you. Take care.